Hello friends, welcome back to the channel. What you are seeing on your screen is a representation of a stock which has fallen by almost 30% in the last 3 months. So whenever we see such a price action, the first thing that comes to mind is, has this stock become so cheap that I can start buying this stock? But we must also remember this fact that a falling price does not always mean that the price of the stock has become undervalued. There is a method that must be followed to identify whether the falling stock has already fallen to a level where it can be called as an undervalued stock or not. So in this video, we will talk about that method that we can use to find undervalued stocks. So let's start the video. Before we go and talk more about how to find undervalued stocks, let me give you a small introduction about what is the difference between the price and value of a business. What is price of a business? Price of a business is something that we see every day on our screens, on our business news channels. The number that is displayed on our screen is the price of the stock. It's very easy to find. And it is a very volatile number. It keeps changing every second. And what makes this price so volatile? It is because of the news flows. It is also because of the change in the investors' sentiments that is causing the price to remain so volatile all the time. Compared to the price, when we talk about the value of a business, the value of a business is comparatively more stable. Why it is stable? Because the value of a business is derived from the profits and the future growth prospects of the business. We will discuss more about how the growth and profit factors influence the value of a business. But for a time being, let's understand this concept first, that there is a difference between price and a value. If you want to visualize how price is different from value, you have to see this curve. In this curve, you see price is almost like a sine curve. It goes up, it goes down, and its volatility is almost permanent. But compared to the price, the value line you can see is more stable. So this difference between the price and the value of the business is what creates an opportunity for the investors. Because value is more or less stable and price is very volatile, whenever the price comes below the value of the business, that is the opportunity for the stock investor. To understand this opportunity thing, let's take an example of a business whose calculated value, let's say, is rupees 150 per share. That's the value of the business. And the stock price of that business was 80 rupees per share. So you can see there is a gap. There is a gap between the calculated value and the stock price. For this business in particular, we can say that this business is valued at rupees 150 per share, but its stocks are available at 80 rupees per share. So this type of business is what we call as an undervalued business. And whenever a business is available at an undervalued price, that is where the opportunity exists. And you have to remember, what is creating this opportunity? The opportunity is created by price being volatile and the value being a more stable entity. So this is the concept that we have to keep in our mind, that what is price and what is value. Value is something that has to be calculated. It is not so readily available. And price is something which is available everywhere. You open a newspaper, you open a news channel, and the price will be displayed everywhere. But people who know the value of the business, they only can locate the opportunity. Now that we have understood that there is a difference between the price of a stock and a value of a stock, let's discuss a bit more about the value thing. When we say value of a stock, we are essentially talking about the intrinsic value of a stock that needs to be calculated. And how to calculate the intrinsic value? To calculate the intrinsic value, you must know the future cash flows. And suppose for a business, we have estimated that after 1 year from now, it will generate 100 crores. After 2 years, it will generate 112 crores. After third year, it will generate 125 crores. In fourth year, it will generate 140 crores. And in the fifth year, it will generate 150 crores. So what we have to do to calculate the intrinsic value, you have to add all these future cash flows. But the only caveat is you have to calculate the present value of all these future cash flows. And once the present value of these future cash flows are known, sum it all together and what you will get is the intrinsic value. We will discuss in more detail how this calculation is done, what it means by the present value and how to do this calculation. We will see all these things later, but for the moment just remember that to calculate the intrinsic value you should know the future cash flows and you should know how to calculate the present value of the future cash flows, and we have to add all these future cash flows to get the intrinsic value. This is the concept. And why we have to calculate the present value? It's because we know that the value of money depreciates with time. Let's understand time value of money from the perspective of a spender. Suppose you are somebody who has 100 rupees in his hands today, but what happens to that 100 rupees 1 year from now? Suppose inflation is 4%. So what will happen? The same 100 rupee will cost 96 rupees 1 year from now because the value of your money gets deflated because of inflation. So what was valued as 100 rupees today will be valued as 96 rupees 1 year from now. So this is understanding time value of money from the perspective of a spender. Let's understand this from perspective of an investor. Suppose you have 100 rupees in your pocket. What you can do with this 100 rupees? You can invest this 100 rupee, let's say in a fixed deposit which gives you 7% returns. So what will happen to your 100 rupee 1 year from now? It will become 107 rupees, right? So you can see your 100 rupees today is worth 107 rupees of tomorrow. This is what is the concept of time value of money. So that's why experts say that when you know the future cash flows of a company and you have to calculate the intrinsic value, you have to first compute the present value of the future cash flows and then only you will get the intrinsic value. So this is basically the concept that we will use to calculate the intrinsic value of a business. Now we will discuss the method that we will use to find the undervalued stocks. It is basically a 3-step process where step 1 is we will do the screening of the stocks. In step 2 we will calculate the intrinsic value of the stocks, and step 3 is basically a comparison step. So when we will do the screening of the stocks, basically we will use 5 filters here. The filters will be on the basis of return on capital employed, ROCE, on the basis of EPS growth rate. We will check the debt level of the company. We will do the screening based on the free cash flow of the company, and finally on the PE ratio. Once these filters are applied to the stocks, we will get a list of few handful of stocks, and these handful of stocks we will calculate the intrinsic value, and the intrinsic value calculation will be based on the DCF method, where first we will estimate the base free cash flow for the company, and based on this base free cash flow we will estimate a growth rate, and based on that growth rate we will calculate the next 10 years future free cash flow of the company. Then those future free cash flow will be discounted to the present value, and we will also do the estimation of the terminal value of the company, and then summing up all the present value of the 10 years and the present value of the terminal value, we will add both these numbers, and what we will get at the end is the intrinsic value of the company. And at this stage in step 3 what we will do, we will compare the current price of the stock with the estimated intrinsic value, and by this comparison we will come to know if the stock is undervalued or overvalued. So this is the 3-step process that we will discuss now in the video. Let's start with the stock screening. To just give you an idea about how this step 1 of stock screening works, I want you to imagine an inverted funnel. In that funnel, imagine that we are pouring all those 5,000 stocks that we have in the stock market, and then inside that funnel basically there are 5 filtering sieves we have put, and the function of all these sieves is to filter all the stocks one by one based on certain criteria. So the first criteria that we have used is return on capital employed. The second criteria is EPS growth rate. The third criteria is the debt level of the company. The fourth criteria, the free cash flow, and the fifth criteria is the price to earning ratio. Note the order in which these filters are applied. This order has been finalized based on my experience because for example, suppose free cash flow becomes the step 1. What we are doing essentially here is that we may be calculating free cash flow of a company whose EPS growth rate is negative. So it is needless to calculate the free cash flow of a company which is showing a negative growth rate. So that's why I have decided that this order of filtering has to be followed. So these 4 steps will give us an idea about the business fundamental of the company. It will tell us whether it is strong or weak, and once all these 4 steps are confirmed, then only we will go to the step 5, where we will check the price to earning ratio to confirm the valuation of the company. So after application of all these 5 filters, as per my experience, I have seen that about 10 to 15 number stocks will get filtered. Out of 5,000 stocks we have started, what we will get, we will be only 10 to 15 number stocks, and on these 10 to 15 number stocks we will do the intrinsic value calculation. You can see in step 1 we will do the screening, and in step 2 we'll do the intrinsic value calculation based on DCF method. So let's discuss all these 5 filtering steps one by one to understand how these steps work to filter our 5,000 stocks. Okay, let's talk about filter number 1, which is return on capital employed, or ROCE. You can imagine there is a company where the employed capital used to run the business is, let's say, 100 crores, and the profit that the company is generating is 20 crores. And when I say employed capital, it is that capital that has actually been employed to run the business. For example, a company which has kept a lot of liquid cash, or it has kept some investments in other companies, that money is not employed by the company to run its business. So we will remove the cash, we will remove the current assets of the company, which is not actually being used to run the business. So that is the employed capital of the company. And let's say, for example, the employed capital is 100 crores and the profit, the EBIT, earning before interest and tax, is 20 crores. So the ROCE of the company will be EBIT divided by employed capital. So in this case, the EBIT is 20 crores, the employed capital is 100 crores. So the return on capital employed is 20%. So once we have this 20% in our hand, we will use this scale to judge whether the company is acceptable to us or not. So in this scale, you see there are 4 levels of returns that we are comparing with. The 4% return you can see here is representative of the return that we can generate from the savings account. 7% return is representative of the return we can generate from the fixed deposit. Index fund will give us a 12% return, and a normal diversified equity mutual fund will give us a 15% return. So a company whose return on capital employed, let's say, is 4%. So what we will think about that company? We will say that if the company is generating only a 4% ROCE, the same return I can get from a normal savings account. So why we will need to buy a stock for that? So we will reject a 4% ROCE stock. Then suppose there is another stock which is not generating 4% but slightly higher at 7%. But 7% return we can get from a fixed deposit itself. Why we will need us to invest in a stock for that? So this stock we will reject. This 7% ROCE is not good enough for us. Now suppose there is a stock which generates 12% ROCE, not bad, but this 12% ROCE you can invest by simply investing in an index fund. It will give you a long-term 12% return. You don't need to invest in an individual stock to get that kind of return. So this 12% ROCE is also rejected. I will also reject a 15% ROCE, which is kind of a good number, but I will say to myself that this 15% ROCE I can get from a decent mutual fund. Why I will need to take the risk of investing in an individual stock? So what I am essentially doing here is I want to find that stock which has a capability of generating a return higher than 15%, and to get to that return I need a stock whose ROCE is greater than 15%. So here the filter that we are applying for ROCE is greater than 15%. So now let's talk about filter number 2 that we will use to screen our stocks. It is EPS growth rate. Now before we go into the details of the EPS growth rate, just to give you an idea about what is EPS. Suppose there is a company whose net profit is, let's say, 150 crores and the total number of shares outstanding in the market is, let's say, 15 crore numbers. So the EPS of this company will be 150 divided by 15, which is rupees 10 per share. So this is the way we can find the EPS of the stock and what kind of EPS pattern we want to see in a stock. Suppose there is a stock whose EPS in FY21 was 8 and then in the next year it jumped to 9.5, and then it becomes 11, and then it became 13, and now it is 15 per share. So this is a kind of pattern we want to see in a stock where the EPS is continuously increasing. And in this particular example, where the EPS has increased from 8 per share to 15 per share, represents a CAGR growth rate of 15% per annum. So why a growing EPS is important to us? Because a growing EPS is a representative that the company is for sure profitable. Growing EPS will also ensure that the intrinsic value of the company keeps rising over the years. And when there is a company whose profitability is increasing and whose intrinsic value is also increasing, the stock price of such a stock also goes up. So it will, for sure, for investors, it will make money, it will do capital appreciation. For a falling EPS stock, it is a no growth stock. So straight away, investor should reject a stock whose EPS is falling, because a falling EPS will result in a falling intrinsic value. As an investor, it is completely not acceptable to us. Generally, this falling EPS stock, you will see that they trade at a low price to earning ratio, but don't be fooled. Those are simply a value trap. Because its EPS is falling, they will trade at a low PE multiples, because expert investors will not invest in such a stock. So they will trade at low PE. That's why I have kept EPS growth rate as the filter number 2 in our stock screening criteria. And for me, the criteria that I want to keep to filter a high quality stock is EPS growth rate should be 10 or more. I do not want to keep a very high EPS growth rate, because sometimes even good companies need to dilute their shares to get some funds from the market. So EPS growth rate need not be very fast, but even if it is growing at a 10% rate, I think it should be good enough for us. Okay, now we will talk about the filter number 3. We will check the companies for their debt burden. As an investor, we should avoid investing in those companies which have a very large amount of debt in their balance sheets. And why it is dangerous? Because a large amount of debt means that the company has a huge interest burden, and this interest burden, it makes the company very vulnerable in the time of crisis. Because if something goes wrong and the company is not able to pay its AMIs, it's not able to repay its interest, then those kind of companies which go into the bankruptcy proceedings and all that. So as an investor, I simply want to protect myself from investing in those companies which have even the remotest possibilities of becoming bankrupt. And one of the very strong indicators of a company eventually becoming bankrupt is a high debt to equity ratio level. So this is the parameter that I like to see in a stock. I simply do not want to invest in a high debt company. And there is another problem with a high debt company. Because of the interest burden that these kind of companies have, their free cash flow generating capability is also very limited. And that is why more often than not, I find these stocks always trading at overvalued limits, because their free cash flow is always low, and a low free cash flow eventually yields only a low intrinsic value. I like to see a company which is almost like a debt free. But when I say debt free, I don't mean zero debt. For example, let's say a stock has 100 crore debt in its balance sheet, but it also has 500 crores of cash in the balance sheet. So net of cash, this company is almost like debt free. These kind of companies generally have a very low debt to equity ratio, and the debt to equity ratio, the level that I personally like, is below 0.3. If I have to screen my stocks, I will screen it for a debt equity ratio below 0.3, and if I have to adjust, then I will increase my debt equity level maximum to 0.5, not above. Okay, let's now discuss about the filter number 4. Suppose there is a company which has reported a net profit of 100 crores. We want to see how much of this net profit is getting converted into free cash flow. Generally what happens, that company can report a good net profit number, but out of those net profit numbers, how much of that reported number is getting converted into cash? That is the important thing, because you can bill a client for certain things, but whether the client is paying that amount, full amount or whatever, that is a very important thing. So when we are dealing with free cash flow, what we are talking about is, it is free cash flow is equal to operating cash flow. This is the cash flow, this is the net cash that has been collected by the company minus the capex, the capital expenditure expenditure that the company needs to undertake to grow its business to a reasonable level. So here what we have to check is how much of net profit is getting converted into the free cash flow of a company. Out of the cash that the company has collected from its customers, it has to spend a lot of money in the form of maintenance capex, in the form of growth capex. It also needs to maintain a certain level of cash to manage its working capital, which is a very important criteria. After all these adjustments are made, what is left with the company is the free cash flow. In our screening criteria, we want to see a company which is not only reporting positive net profit, but it is also converting its net profit into cash flows. That cash flow, after adjusting for maintenance capex, growth capex, and the working capital, that cash flow must not only be positive, but it also must be growing. So now let's discuss about the filter number 5 of our screening tool, where we will do the PE ratio analysis of the stock. Suppose there is a stock whose stock price is 200 rupees and its earning per share is 10 rupees. So for that stock, the PE ratio will be 20x. So what does this 20x tell us? It tells us that the stock is trading at 20 times its net profit. But just by looking at the 20x multiple, the PE multiple, we cannot conclude anything about the valuation of the company. So what we should do? We should do 3 simultaneous checks on the company. The first check should be, we should compare the current PE of the stock with its historical PE ratios. Suppose in the past the company has traded at a PE multiple of 25x and now it is trading at a 20x. There is a hint that this stock may be undervalued. Similarly, we should compare the stock with the PE ratio of the entire industry. Suppose the entire industry trades at a PE ratio of 22x and our stock is trading at a PE of 20. So this again gives us a hint that this stock may be trading at an undervalued level. The best check is to compare the stock's PE ratio with its peer companies. Suppose there is a company, a competitor company, which is trading at a 15x multiple. There is another stock which is trading at 21x multiple, and the third stock is trading at 23x multiple. So you can see, as compared to peer 2 and peer 3, our stock looks slightly better valued, but with peer 1 it looks overvalued. So what we should do? We should go back and start checking this peer 1. And what we should check about the peer 1? Again, we should check the ROCE multiple, the EPS growth rate, the debt to equity ratio, and the free cash flow. So this way we can do the PE analysis of our stocks. Okay, now that we have seen how to screen the stocks, we are now ready to go to step 2, where we will understand how we can calculate the intrinsic value of our stocks. So to calculate the intrinsic value, the first step, the step A, is to estimate how much free cash the company is generating as of today. The step B will be, we have to now estimate how much free cash the company will generate in times to come. So we will try to estimate the free cash flow of the company for the next 10 years. For today, we know the free cash flow from here, and we will assume a suitable growth rate, and based on that growth rate, we will try to estimate how much free cash flow the company will generate in year 1, year 2, year 3, and so on till the 10th year. In step C, what we will do, we will calculate the present value of all these future cash flows that we have estimated for the next 10 years. We will do the present value calculation for all these future cash flows. So this will be step C. And in step D, what we will do, see, basically what we are doing, that from year 1 to year 10, we are estimating the free cash flow of the company in this step, in the step B. But after the 10th year, the company is not going to die. It will continue its operations, right? So based on all the cash flows that the company is going to generate after the 10th year onwards, we will use those cash flows as an estimate, and we'll try to calculate the value of the business, and that value of the business is called as the terminal value of the business. So this we will do in step D. In step E, what we will do, the value that we have got in step C and step D, we will find a sum of those values, and what we will get is the intrinsic value of the business. This will be the intrinsic value. And if we will divide the intrinsic value by the number of shares, we will get intrinsic value per share, which we can compare with the stock price. So the step A is to estimate a base FCF of a company as of today. The base free cash flow can be calculated. We have to open the annual report of the company, and we have to go down to the cash flow report of the company. In the cash flow report, we will find a line item which is called net cash flow from operations. Suppose for a company, the net cash flow from operation is 130 crores. In the same cash flow report, under the heading of cash flow from investing activities, you will find a line item which will be indicated as cash invested for property, plant and equipments, or you can also find it labeled as a capex. Suppose for a company, the capex is, let's say, 30 crores. For this company whose cash flow from operations is 130 crores and whose capex is 30 crores, its free cash flow will be 100 crores. This 100 crore becomes our starting point. This becomes our base free cash flow. Now on basis of this base free cash flow, we will try to estimate the future cash flows of the company for the next 10 years. Here in this example, I have assumed a free cash flow growth rate of 12% for the first year and 8% for the next 5 years. I've assumed 12% for the first 5 years and 8% for the next 5 years. From where I have assumed this 12%, you can open the profit and loss account of the company and see the EPS growth rate. Try to calculate the growth rate, EPS growth rate of the last 5 years of the company. So whatever is the EPS growth rate, let's say the EPS growth rate comes to about 12% per annum. So you can use this number and assume that the company will grow at the same rate for the next 5 years as well. But what I will suggest is that this growth rate number you should assume only for the next 5 years. For further 5 years, you should assume a slower growth rate. For example, here I have assumed 12 and for the next 5 years I have assumed only 8%. What was our base FCF? The base FCF is 100. So adding 12% to this 100 crores, what will be the free cash flow for the first year? It will be 112 crores. Now to 112 crore, we will add another 12%. It will become 125 crores. So this way we can calculate the free cash flow for the next 10 years. So once you have done this calculation, you are ready for the next step. Now in the step C, what we will have to do, we have already calculated the free cash flows for the next 10 years. What we have to do now is to calculate the present value of all the future cash flows that we have calculated. How to calculate the present value? For the first year, the free cash flow that we have calculated is 112 crores. Divide this free cash flow by the assumed discount rate, and in this case we have assumed a discount rate of 12%. So what will happen? 112 divided by 1 plus 0.12 is 112 divided by 1.12, which will be 100 crores. So this way we will do the calculation for all those years. For the second year, the calculation will be, for second year, the free cash flow that we have calculated was 125 crores. So it will be 125 crores divided by 1 plus 0.12, 12% to the power of 2. So in this case, we will get the value 99 crores. Similarly, let's say we are calculating for the ninth year. For ninth year, what we will do, what formula we will use? For ninth year, the free cash flow was 239 crores. So 239 divided by 1 plus D is 12%, 0.12 to the power of 9, because we are calculating for ninth year. So in this case, the present value of the future cash flow will be 86 crores. So you can see this way I have calculated the present value of all the future cash flows for 10 years. So adding all these cash flows, the value that I am getting here is 948 crores. Now there is another concept that we have to keep in mind, and that concept is the terminal value concept. What we have done in this step is we have calculated the intrinsic value of the business based on only 10 years of FCF. Okay, but the business is going to operate after the 10th year also, right? It is not going to close down. So based on the free cash flow generating capability of the company beyond the 10th year, so there will be intrinsic value attached to this number as well. Okay, so that is called the terminal value. So what we have done here, for the first 10 years, we have calculated the intrinsic value and it came out to be 948 crores. Okay, this was the 948 crores. But after the 10th year, the company is not going to close down. It is going to operate and it will generate some free cash flow. We have to use a concept called the terminal value concept, and the formula for terminal value, we have estimated the free cash flow for the 10th year of the company. So free cash flow for the 10th year into 1 plus G divided by R minus G, where G is the terminal growth rate. For assumption, I have assumed a terminal growth rate of 5%. My suggestion is your value should be in between 3 to 5%. And the discount rate we have assumed as 12%, so we will keep as it is. So now what we will do, we know the free cash flow of the 10th year, which is 258 crores. And now we will calculate the terminal value. The terminal value will be, the formula will be 258 into 1 plus 5%. Why 5%? Because we have assumed the terminal growth rate as 5%, and then divided by the discount rate minus terminal growth rate. This is the formula. By using this formula, the terminal value of the company will be 3850 crores. Again, for this terminal value also, we must calculate the present value of this terminal value. So how to calculate the present value? We know the present value is free cash flow that we have calculated divided by 1 plus discount rate to the power 10. So this value will come out as 1246. So one present value we got was 948 crores for the 10th year, and beyond the 10th year the value that we got was 1246. Now how to calculate the intrinsic value? The intrinsic value of the company will be the present value for the first 10 years and the present value of the terminal value. Once we add these two values, what we will get is the total intrinsic value of the company. And in this case, in our example, for the first 10 year, the intrinsic value was 948 crores. For the terminal value, it is 1246. Adding these two, we will get 2194 crores. So basically the intrinsic value of the company is 2194 crores. Now what we should do to understand whether the company is undervalued or overvalued, what we should do? We should do a comparison. We can basically do two types of comparison. First is we have to compare the market value of the company with the intrinsic value. Now to compare the market value, there are two ways we can do. Either we will use the stock price method or we will use the market cap method. Suppose the market cap of the company is 3000 crores and its estimated calculated intrinsic value is 2194 crores. So in this case, the company looks to be overvalued. Why? Because the market cap is more than the calculated intrinsic value. There is another method. What you can do, suppose this stock has 100 crore shares outstanding in the market. So what will be the market value per share? That is the stock price. It is rupees 30, 100 number shares to the intrinsic value because number of shares outstanding was 100. So what we will get? 21.94. The share price is more than the intrinsic value per share. So this way also the company is looking overvalued. Knowing intrinsic value is not enough. According to Warren Buffett, we must also build some factor of safety to our estimated intrinsic value. Why we have to build factor of safety? Because we can always make mistakes. See, intrinsic value calculation is not a very hard science. We have done a lot of assumptions and based on that we have arrived at an intrinsic value. So we can make mistakes. So how to factor in for those mistakes? The way to factor in for those mistakes is to build a margin of safety in our calculation. So what is margin of safety? To understand the margin of safety, let me explain to you. What you see on your screen is a bridge, and on that bridge there is a big trailer. Suppose the capacity of the bridge is 12 tons and the trailer that runs over that bridge, let's say, is of 7-ton load. So you can see there is a gap between what the bridge can take, 12 tons, and what the trailer is weighing. So there is a gap of 5 ton, right? So this is what is called the margin of safety. The bridge has been built for 12 ton capacity, but the truck that is being allowed is only for 7 ton. So this is the gap, and this is the gap that we should maintain also in our stock. Suppose our estimated intrinsic value is 100 rupees per share. So what we should do? We should while buying the shares, we should think that by applying a 25% margin of safety, what we should do is we should buy a stock which is not at 100 but at rupees 75. So this way we are using a 25% margin of safety. In this video, we have seen a method to find undervalued stocks. And what we have done, we have put all the 5,000 stocks listed in a stock exchange to our 5 filters that we have finalized, and the result of those 5 filters will be we will get 10 or 15 quality stocks. For all those 10 or 15 quality stocks, what we will do, we will use the DCF method to calculate its intrinsic value, and then to that intrinsic value we will apply a suitable margin of safety, let's say 25% margin of safety. And after applying the margin of safety, if the current stock price is trading below the intrinsic value after applying the margin of safety, then we will buy that stock, and if it is not trading at a reasonable price level, then we will add that stock to our watch list, because these are all good quality stocks. Maybe they are not trading at a good price now, but tomorrow they may fall below further and we may get an opportunity to buy them.